Atocha Global Analytics. Please like and subscribe.
Hello everybody, this is KT with Atocha Global Analytics. I wanted to remind you that Atocha Global Analytics was created to provide insight and foresight into the street level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. Today we're going to look at an office building property that I found. This is very cool. This is a property that was offered for sale in 2020 and is currently offered for sale again. They use a lot of the same numbers, but they also have updated a lot of them, so it reflects the market at two different times. I also wanted to use this as an opportunity to highlight some of the issues that are inherent when financing properties about how financing structures impact the value of buildings or the amount of money you can actually borrow on the buildings. So here we go. We have a 2020 office building, and I'm not going to go into the specifics of where or anything because I'm not wanting to advertise the property. I'm not wanting to lead people necessarily to it because I'm not a real estate broker. But this property, it's a 47,000 square foot building that was leased for $15.92 a square foot. And so the potential gross income, or the annualized gross rents, as they often are called as well, $758,000 or so. Back in 2020, they used a 10% vacancy and collection loss. A lot of areas it was actually even better than that. It was 95%, but they happened to use the 10% here. And so that gave you an effective gross income of $682,000 a year. Now, for some reason, they switched to monthly. And so I replicated what they did, so just to be consistent with how they reported it. And you can see there what they reported on a monthly basis for all the different categories. And that left a total monthly NOI of $43,301. The net operating income, 12 times that, of course, is just shy of $520,000. At the time, the building had a price of $13 million, so that worked out to be a cap rate of 4%. Okay, so here is where I wanted to highlight debt service coverage ratio, or sometimes called debt coverage ratio. The definition is debt service coverage is the ratio between net operating income and total debt service. And in a nutshell, that means it's a cap on the amount that you can spend on your debt service. So how that applies here is that based on the NOI, the maximum you can spend on debt service is $433,000 or so. The debt service coverage ratio in this case, they reported was 1.2. I looked, and that is essentially what many lenders are requiring. So the maximum debt service you can then have is $433,000 a year, which means at the given interest rate, the maximum loan that you can borrow via the debt service coverage ratio is $7.8 million. And the maximum loan to value at 75% means that really the inferred purchase price that the lender is imposing is $10.45 million. Now that means the maximum they will loan. Now if you wanted to go out and spend the $13 million on the building in 2020, everything above that $10.4 million is out of your pocket, but actually everything above the $7.84 million is out of your pocket. So you can take a much larger equity position, but that is the maximum they will do. So let's fast forward to 2023. Things have changed significantly. Everything has moved rather quickly. The vacancy rate has increased significantly. In many places, it's over 50%. In this particular area, it is actually running 35%. But on the current marketing for this property, it's not. So they still got it shown as being leased for $15.92 a square foot. The annual gross rent did not change. However, the vacancy and collection loss, they've increased it from 10% to 25%. Now they happen to have some long-term leases in place with some tenants that have been there for some time, but they anticipate a significant change. However, that's not market. That is fairly subjective. So they went with 25. We'll go ahead and use their numbers because this is just an example. They left the percentages for many of the expenses exactly the same. Of course, if you have a significant shift in income, the percentage would change a little bit because some of these are fixed expenses. They aren't proportional. But we'll still use their numbers because this is just an example again. All right, so we have a revised net operating income of about $410,000, and their current price is at $8 million. And so, of course, the cap rate inferred by that is 5.12. So the cap rate shows 1% higher, a little more than 1% higher. All right, so based on the debt service coverage ratio that has remained the same for 2023 and the lower NOI, it's down to 340,000 or so for that number. So the maximum debt service, the debt service coverage ratio infers that you can borrow no more than about $4.36 million. The interest rates right now are significantly higher. I shopped around a little bit and it looks like 6.8 is probably in the ballpark of where you might be able to get right now on this property. The max loan to value ratio, okay, that has come down a little bit. You could get 75% pretty easily. Right now, it might even be a challenge to get 70% from a number of these lenders I looked at. So the inferred purchase price, based on those factors, is $6.228 million. So the appropriate going in price then is $6.228. Again, you can come out of pocket, you can put in additional equity, but it is a significant change, and I wanted to highlight that. So the total decline in inferred maximum price resulting from the financing impacts is about 40%. That's a 40% decline. Yes, a 40% decline. And that is the new reality we have in 2023. Thanks for watching. Catch you next time.
Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.